Asta, can you please initiate? Can you please?
Yeah, of course. Good evening, everyone. Thank you so much for joining and welcome to the webinar on property investment strategies for 2026. Today, we're going to explore how to navigate the market with trusted independent advice in strategic approach designed to help you guys to build long-term wealth. Before we begin, please note this webinar is for general information purpose only. It does not consider your specific financial or personal situations. Also, consult with your qualified professionals before making any investment decision. So that's important there. In terms of our founders Vikas, Jindal, and Rakesh Garg, they bring over 20 years of combined experience in property market with over $100 million in transaction. Our team provides a full end-to-end approach to property investment. You can, if you don't mind going to the next slide. Yeah, that's our team there. Our team, of course, now our team provides a full end-to-end approach to property investment, and you can meet or speak to any of our dedicated team members or experts on a one-on-one session as well. From sales and delivery consultants to IT and management professionals, we are committed to guiding you through every step of your investment journey. As finalists in 2026 REB Innovation Awards, our team is passionate about delivering strategic outcomes. We focus on expertise, integrity, and data-driven insights to help reach your property goals. So in this webinar, we are going to examine why residential investors are increasingly turning to commercial property under $500,000. So we will be looking at benefits of higher yield, a longer lease, and portfolio diversification. Our track record for 2026 includes 77 settled commercial properties across 6 states and territories, totaling over $53 million in value. This demonstrates our ability to deliver results across diverse Australian markets. And with that, I would like to hand it over to our co-founder and property expert, Rakesh.
Good evening, everyone. Thanks everyone for joining this webinar. Today's webinar gonna be very important, and you guys must be having a lot of questions, and we will endeavor to answer all your queries. Whenever you got question, you can put it in the chat window, and after I think 10 to 15 minutes, we'll take your question. Then we'll take more question towards the end of the webinar. So the main topics that we're going to touch in today's webinar is the budget impact, like what impact does the budget have on the upcoming investments. Then we will talk about negative gearing, how it works, how it's going to change with the new budget that have changed, SMSF borrowing changes that has happened, why you shouldn't rush into residential, what is the policy shift happening, why investors are diversifying, resi versus commercial, income and cash flow, what are the concepts behind leases, what is the definition of whale and tenant quality, how we assess that, real life case studies which we have purchased under 500K, what are the different myths for the commercial properties, and the practical strategies to buy properties in 2026. So we're going to discuss all these topics in today's session. So let's do a quick maths where we will see why the commercial gonna be enormous in the coming years. There are total of 285 billion transactions invested into the residential property annually in Australia. So $285 billion, whereas the commercial market is not even 1/4, less than 1/4 of that, which is around 59.9 billion every year, including owner occupier, each and every type of asset in commercial market. So considering the small size of the commercial market now with the change in the SMSF lending and the negative gearing, if just 10% of the people from the resi, if they shift to the commercial, just 10% means $28.5 billion of investment if moved to the commercial, it will add up to 48% growth to commercial. Just 10% moving from resi, which is going to happen anyway because there is no option left for the SMSF people who were counting on the negative gearing, they have to make the shift. So it's gonna add a lot of value. Even if with 5% people shifting from resi to commercial, there will be 24% growth that will be there in the commercial market. And there are 1.1 million investors who are investing in the resi market. They are reassessing their growth. They are reassessing the different strategies, different options available in the market so that they can buy the cash flow and good potential for capital growth assets. Now, what happened with the negative gearing? Most of you already know. I'm not gonna put a lot of time on this. Just quickly recap. For residential, you can't do any losses. You can't offset your losses against your salary. Any negative gearing that is happening, you can only take forward in the coming years when you sell your property or your property becomes positively geared. Then only you can do your negative gearing. So new residents build remain exempt and keep negative gearing. So if you're buying a property which is new, either it's a newly built or it's under construction, that will still be applicable having the negative gearing. Any properties you have bought before 12th of May, they are grandfathered until sold. So you can still do the negative gearing on those properties. But commercial, none of these is applicable on commercial. All rental losses fully deductible against salary and wages. There is no bill date condition. It can be you can buy established or new properties. There is no expiry date for the that you have to buy new property or old. So permanent there. So and there is nothing like you can only buy new. You can buy any commercial asset type, industrial, office, strata. Every property qualifies for the negative gearing. Every property qualifies for the capital gain tax deduction. So it's fully proof as before budget. Now, what is being banned from SMSF? As you already know, there is a lot of news coming for SMSF from 10th of August. You can't buy any more residential properties because they have stopped the LRBA, which is the limited recourse borrowing arrangement, through which the lenders will be lending the money for SMSF buying. So no more residential properties can be bought after 10th of August. But you still can buy commercial properties in SMSF. There is no rule change for the commercial purchase. There is no time limit that you have to sign the contract before 10th of August. You can sign the contract anytime. So why does this matter now? Why 10th of August matters a lot? So lot of people whose SMSF were set up already, they have done their rollover. They were rushing to buy because they think that 10th of August is the deadline. If they don't buy, they're gonna lose the opportunity. They have already done rollover. They have spent money on setting up their SMSF and all the cost associated with the expenses. So they are rushing, and with this temporary demand, they are buying properties which are above the market price, because most of the SMSF investors have the budget between 500 to 800K. So all the properties which are in this range in the growth areas, and everyone wants to buy in growth areas, there is a limited supply. So people are buying above market price and they are paying the premium value. Whereas if they should wait and they can explore the commercial market where all the rules are still applicable, all the old rules are still applicable, and in the future if they need to sell the property, they need to change their lender, they can do that. Buying residential, you may stuck because there is no future lending available under SMSF residential. So you may be stuck to a single lender where you are already with. Maybe you're not able to refinance. Maybe you're not able to go to a lower interest rate. So that can happen in the future if you're buying your residential in rush. If you have already bought in the past, you are already having all the benefits. You don't have to worry about. But if you're buying in rush, you should consider whether it's making sense for you or not. Now, why people are again considering commercial? Negative gearing fully retained, as I mentioned. You can do negative gearing without any change. Higher yields in commercial, as we mentioned, as you have seen our success stories, we are getting yields between 5% to 9%, whereas in residential, you are getting yields between 3 to 4%, which is gross. We are getting 5 to 9% net rental returns. In commercial, tenant pays all the outgoings. Outgoings, you know, that's the biggest headache for the resi buyers. The council rate, water rate, strata repayment, which keeps on increasing every year, your insurance premiums, other expenses, which you can't control. Whereas in commercial, you don't worry if even if your expenses increase by 10-15% every year, these are the responsibility of the tenant, irrespective. There is no cap that if the insurance premium increase by this much, the tenant will not pay. It's irrespective of the change. All the outgoings will be paid by the tenant. SMSF borrowing still available, which is a big positive thing. You can still buy under your SMSF. There are long-term leases in commercial. You can buy property with lease starting from 3 years, going up to 20 years. So the land tax is low. If you're buying a property in strata, there will be a low land tax for the commercial properties, which will again be a money saving for the investors. Now, again, a bit of in the tabular form, I will quickly explain the differences between residential and commercial. No negative gearing from 1st of July 2027. In commercial property, the negative gearing is fully retained. The typical yield is 3 to 4.5% on resi. For commercial, it's 5 to 9%. The outgoings in resi, it's paid by the landlord. In commercial, it's paid by the tenant. Lease length in resi is 6 to 12 months. In commercial, it starts from 3 years and goes up to 20 years. Rental review every year. SMSF borrowing is banned from 10th of August in residential, whereas for commercial property is still available. Land tax, full land tax per dwelling you're paying on residential, full land value. If you're buying under strata in commercial, you're not paying on full threshold. Depreciation is a big thing which no one discuss and no one even knows about. I will bit explain about this. Before 2017, if you are buying any old residential properties before 2017, you can depreciate the plant and equipment. Any plant equipment you have, like your air conditioning system, your heating system, your appliances like hot water system or anything can be depreciated. But in 2017, they come up with a new legislation that if you buy any old property, only the building can be depreciated, but you can't depreciate the appliances or any other equipment in your residential property. That's where if you buy any old property, the depreciation will be very low. And if you buy a brand new property, you can still depreciate your appliances and equipments, and your depreciation is quite high. Whereas in commercial property, this is not such the rule. You can buy even a 40-year-old property, 50-year-old property. Still, you can depreciate each and every equipment, each and every appliance in that property. That's where the commercial property buyers get much higher depreciation value per annum as compared to the residential, which is again a direct income which no one considers. So regarding the capital gain tax, no, residential is banned. You can't buy anymore. But for commercial property, the tax is 10%. If you sell after 12 months. If you hold the property for 12 months, there is a 10% capital gain tax. And if you're selling your property during your pension phase, then there will be a 0% capital gain tax in your SMS. Now, what are the bit of myths of people have about commercial property and what are the actual reality about that? People have a myth that in commercial, there is a high vacancy risk. But the reality is, if you have done your proper due diligence and you have bought a property with a strong tenant, a national tenant, blue chip tenant with strong fundamentals, very rarely your property become vacant. And even if your property become vacant, let's assume the amount of money, the amount of rent you have collected in 2 or 3 years. By the time when you purchase the property, you purchase a leased property with 2 or 3 year lease already in place. The amount of rent you have collected can easily fund you for next 6 to 12 months, and still you will be positive in total money. So if you come with the numbers are favoring the commercial property. So no capital growth. People think that there is no capital growth in commercial properties. Again, it is not true. So commercial properties have a capital growth, but the only thing is there is no such data available. You can't check whether the commercial property have increased. In you put any address on Google, any commercial property, it will not show you when it was last sold, for how much, what is the current market value as per RP data or valuation estimate. No such public data available, and that's where people never know what was the property history, who got how much capital growth. But if you consider there is an inbuilt increases as part of the lease, 3%, 4% CPU, which keep on increasing your rent. And with the rent increase, automatically the growth is happening. And then there is a rent review at the end of the lease. Suppose your lease is finishing in 3 years, there is a further 5 year option. So when the tenant exercise the new option, then there is a market review. And during the market review, the rent can be increased 10%, 15%, 20%. It all depends on the situation and how strong is the business of the tenant, because tenant doesn't want to relocate just for increasing 10% rent. They don't want to do new fit outs, they don't want to find a new place, because for commercial tenant, location and a proper space is the main requirement. So people think that you need a huge deposit to buy commercial. Again, that's what we're gonna do in today's webinar. We are showing that we have bought heaps of properties under 500K, which everyone can buy if you don't need a big deposit. Too hard to finance. Again, it's not true. Even commercial properties are easier to finance because of high rental return. It adds to your serviceability. If you're buying a residential property of 500K, it's giving you a gross rental return of somewhere around 18 to 20,000. That's a gross rental return. Whereas if you're buying a commercial property of 500K, it gives you net rent of 35 to 40,000. So net rent of 35 to 40. So you can assume if you take both the properties to the bank, one property's income is 18 to 20,000 gross. Second property's income is 35 to 40,000 net. Which property will add to your serviceability? So very easy. No depreciation. Again, it's myth. As I explained before, the commercial properties have a better depreciation as compared to the resi. It's only for big investors. No, that's not true. All type of investors are buying commercial. We have bought commercial property as low as 220K, bought I think more than 30 properties below 500K. So it's just all these are myths, which is not true. As long as you don't come to the market, you will never know what is the option available to you.
So
Now,
thanks a lot, Rakesh.
so
Thanks a lot, Rakesh. Thanks, Astha. So I
I
think yeah, from here now I have to jump on. So first of all, like audience, if you have any questions so far, like whatever Rakesh has presented, whatever Astha has mentioned, you can ask. Otherwise we can go forward. Like if you have any question, you can raise your hand or you can mention your question in the chat box. Otherwise we can proceed further.
I
Okay,
think someone
so
have raised the hand or not. Okay. Yeah, Vikas, please continue.
okay.
If there is any question, we'll take the question.
Yeah. So okay. Thanks again. So basically, in today's webinar, mainly, so Rakesh has mentioned, what are the myths about the commercial property. Like we try to debunk the myths, and we try to show like how the commercial properties are better in terms of the rental returns, in terms of the outgoings, in terms of the tenancy, in terms of the lease length. Everything has been explained by Rakesh in the previous slides, right? So I will focus. Now for the commercial properties below 500,000, because as Rakesh mentioned, majority of the investors always think they need to spend heaps of dollars, to buy their commercial, and below 500 or below 1 million, there will be nothing. They like we cannot buy anything, but it is not the truth. I will show you how these things works, right? So first thing, like commercial properties purchased under 500,000, we will show you the success stories, what we have purchased in the past, and in the last 15 days only, how many properties we are buying, right? So the first thing is lowest entry point. So our lowest purchase price in commercial so far is $210,000. Right. So this was the commercial property which we have purchased. I will show you the location and the rental returns as well. And the highest yield which we have achieved below 500 purchase is 10.56%. And the positive cash flow which we have achieved is $22,300 on a purchase price of 455,000. So you can see investors spend 455,000, and considering around 70% LVR, 30% deposit, he is annually generating 22,300 positive cash flow per annum, which is approx $2,000 per annum, purely a passive income. Right. Next, commercial property types available under 500,000 in Australia. Whenever any investor call us, or they want to start their journey in this real estate industry. So their first question is, what kind of commercial property we can buy? So in reality, basically, there are heaps of commercial assets available in the market. Like there are fuel stations, there are large retail formats, there are what we call the childcare centers, medical centers, and retail shops, office space, industrial lands, blah 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 stuff, right? But considering the price point of 500,000, so these are the options which we generally acquire. It can be the retail shops. The retail shops can be in the strata units, or it can be the freehold. So it can be shopping plazas anywhere in the retail shops, and the office space. Office space again can be in the strata office in metro regional areas, wherever, doesn't matter the location. Industrial unit, for the industrial unit, it can be a small industrial unit, like the land size. It all depends whether it is located into the metro areas or into the regional areas. And medical and consulting suites, again, now we have purchased one medical center which we will show you in a price point below 500,000, but the availability of medical suits in this in below 500 are quite less because the medical tenants required larger space, right? So we can have the optometrists, we can have the dentists with the smaller space, maybe around 90 square meter of office space, though, so they can run there. And the mixed use, in the mixed use, basically we can say it can be a resi commercial. Resi means on the downstairs it can be a retail shop or something, and on the upstairs side it can be a 2 bedroom, 3 bedroom unit house. Right, and then the storage and specialty. The storage units are also available. These are very much in demand. These are mainly into the regional areas, like away from the city, because we cannot get this much of space in the city areas. Right, so these are the properties which are generally available in this price range. Next, 500,000 budget residential versus commercial. So if we compare, if for example, if any buyer, he has a budget of 500,000, right? So what options they have if they enter into the residential property market? So we all know that like we have a audience maybe from different areas of the country, right? So, but if we talk about Melbourne, Sydney, Adelaide, all the metro areas, I don't think like we can buy um, a residential property under this price budget, because we are talking now with too many developers or builders, to enter into the new build industry. But everyone is saying below this price point it is hard to find anything. Even the block of land in Melbourne metro or in Sydney areas, it is really hard to find the land block of below 500,000. You can buy maybe into the regional areas maybe 300, 400,000. But again, if you buy that, of course, like you will keep that property maybe for months, you will start paying the mortgage, and then again there will be a stress on your pocket, and I don't know like from when you will start getting some sort of the rental income from that property. But on the other side, as I mentioned, whenever we buy any commercial property, first thing, that is always tenanted. From the day of settlement, you will start getting the rental income from that property. You do not need to wait for the tenants, right? So whenever the settlement happens, the tenant is always there. We never purchase any vacant property until and unless it is required for a for the purpose of owner occupier. If anyone wants to jump in their business to that, so only then we buy the vacant property. Otherwise, we always buy the tenanted properties. And if we talk about the yields, it is always higher, as we spoke. The tenant pays some or most of the outgoings. It all depends the what kind of lease arrangement is there. Sometimes it is the gross lease, sometimes it is the net lease, and in the net lease as well, it can be single net, double net, triple net. So there are different kinds of leases in the commercial. But as per the experience from the last few years, we have seen majority of the cases, council rates, water rates, these outgoings are being paid by the tenants of the property. Sometimes the land tax, the building insurance, the property management fee, these needs to pay by the landlord. But whenever we do the numbers, we always do based on the net rental income, like after payment of the outgoings, how much money will left in your pocket. So on the basis of that. So the key message from this is basically within the same 500,000 budget, commercial property can provide immediate rental income through an existing lease, whereas residential options are generally more limited in many Australian capital city markets. Next, Rakesh. So now let's talk about the numbers, because whenever the number comes, it starts make more sense to everyone. So for this, basically, I have considered the few assumptions basically. So the first assumption is the purchase price. I have considered the purchase price of 500,000, both for resi and commercial. Loan to value ratio, with this is the mortgage I have considered 350,000, 70% basically 350,000 for both resi and commercial, because sometimes people say in commercial the deposit is more, that's why the rental return is high. But to make the comparison apple to apple, I'm considering 70% loan for resi, 70% loan for commercial, right? Resi interest rate 6.15% interest only component, and for the commercial interest rate 6.55%, because in commercial the interest rate is little bit higher, right? And if I consider now if you do the calculations, yearly rent, I have considered only purchase price of 500,000. Yearly per week rent is $550 per week, and the annual rent is 26,000. On the commercial side, I have to consider 7.5% rental yield, which nowadays it is shrinking, because a lot of movement is coming towards the commercial property. But we have achieved 7.5% in the past, and we are still achieving in today's market as well. So on a very conservative side, I have considered 7.5% rental yield, which is 37,500 of 500 on a purchase price of 500,000. So the rental yield is 5.2%, which is gross. Here 7.5%, which is net, we can say. Mortgage interest only payment per annum. So considering the 6.15% interest rate, you will be paying $21,525 per annum towards mortgage, which is interest only component, and 22,925 for commercial, because here the interest rate is little bit higher. Depreciation 600,000, because on resi the depreciation is little bit lower, whereas on the commercial, as Rakesh mentioned, even for the properties which are 30 years, 40 years old, we are getting good depreciation in the range of 15 to 20,000 easily, right? So the total outgoings per annum, considering whatever we are paying on this resi, in this basically council rates are there, water rates are there, insurance premium, property management fee, some sort of the maintenance. So this is covered, so around 12,000 the outgoings. And on the commercial, what I have considered in the outgoings is the property management fee and some maintenance, because it is generally to the landlord's account. So the cash flow per annum 7,825, because you are getting yearly rent you are getting is 26,000, mortgage you are paying 21,000, and total outgoings is 12,000. So your out of pocket is $7,825. On the other side, on commercial, you are getting $16,700 per annum positive on the same purchase price, same mortgage, same deposit, right? So the return on investment, if we talk about, it is negative here, whereas it is positive in commercial from day one, which is 8.41%. So residential ROI, commercial ROI, you can easily compare this, and the annual swing. So basically, if you invest into the residential, you will be negative by 7,800. But if you have invested in commercial, you will be positive by 16,000. So 16 plus 7, 24,525 will be net impact basically at the end of the year in your on your pocket. So any questions on this calculation if you have any? So yeah, we can discuss more on this then. Rakesh, to the next slide. Yeah, so these are the few commercial properties which we have purchased under 500,000. Right. So like if you go on our website, there are heaps of properties which you can see, but because of this space and all that stuff, we couldn't produce everything here. But if you see, we have purchased the properties in every state: NSW, Victoria, WA, Queensland, South Australia. In all 5 states, we have purchased under 500,000, and the purchase price starts from 210, which I mentioned in my previous slide as well. From 210 to 505, you can see the price point. Rental income, you can see, starts from 22,000 to 33,000. It depends on the rental yield, how much rental yield we are getting. So the average rental yield, if you see here, it is close to 7%. Maybe there is 1 or 2 properties only where it is below 7%. Otherwise, it is always and always above 7%, 7%, 8%, 9.68%, 9.08%, blah, blah stuff, right? And the cash flow for all the properties, the calculation is basically based on 70% LVR, bank interest rate of 6.55%, interest only repayment, right? There are few properties which has been purchased by our investors in their SMSF as well. But to keep all the numbers at the same level, like to do the calculations at 70% and 6.55%, I have shown the cash flow per annum. But if these properties being purchased under super as well, where the interest rate is 1% higher, still these properties will be positive. And the tenant type, like you can see that like there is no there will be no fuel station, there will be no large retail center, large retail formats. So these will be the cafes, like the retail space, office space, multi-tenancy. It is here it is a medical tenant, I guess it was the GP office, right? Pizza shop is there, hearing Australia, real estate agency, beauty salon. So these kind of properties you can buy under this price range. And I guess these properties, like not the 100%, but maybe more than 60% of these properties may be freehold, not the strata, right? So kind of options are there, but yeah. Vikesh, next.
Yeah, moving forward, there is one question from Sandeep Goyal. I want to address that question first before we move to the next part of our webinar. So Sandeep has asked that the risk fee is 1.5%, which is charged by the lender for commercial lending, and there is a higher valuation fee. So Sandeep, your question is valid, but the question is not 100% correct. So risk fee comes into picture when you're going to a tier 3 or tier 2 lender. So they charge risk fee because either your serviceability is not there or you're trying to borrow more than what you can borrow. So right now we have got in last, if we have got 50 mortgages, out of 50 are 30 mortgages are with CBA. In CBA, they are lending you 65% or 70% without any risk fee, zero risk fee. And you asked about the high valuation cost. So CBA is doing commercial loan without any valuation fee. So if you need help, I can point you to a mortgage broker after this webinar. You can contact me or Vikas, and I can share the number of a mortgage broker. So we are getting the mortgages from CBA without any valuation fee, zero valuation cost, no risk fee. So it all depends from where you are getting the lending, who are the experts. So a lot of mortgage brokers doesn't even know that there is such option available that you can go to CBA with property. The only condition of that is that CBA only consider the commercial property as long as there is a arm length contract. Arm length contract means its contract is not signed between two private parties. There is a registered real estate agent involved, any real estate agency involved, and there is a full contract. There is no other condition from CBA. CBA lend you 65% or 70. That depends on the postcode and few other parameters. But we got these two amounts without any valuation cost and no risk fee. For more information, you can contact us later, and we are happy to help. So as
And moreover,
Vikas,
like I want to, yeah,
yeah.
and moreover, I want to add here, Sandeep, on your question. In Resi, we have seen that like the lot of investors who have exhausted their borrowing capacity, they don't left with any other option, right? So then they start going to the smaller lenders with the with the low doc loan options. In the low doc loan options, the banks generally charge maybe 8%, 9% bank interest rate, right? But in terms of the commercial, we have never purchased even a single property on low doc. We have like if the buyer is exhausted with the borrowing capacity, then we go with the lease doc loan. Lease doc loan is basically bank provides you the mortgage on the basis of the lease of the property, and the interest rate is quite similar, 6.5%, 6.7%. So you don't need to pay higher interest rates to the banks if you are exhausted with your borrowing, right? And these kind of lease doc loans are available with all the four big banks, with CBA, Westpac, NAB, ANZ, anyone. You don't need to go to the smaller lender as well. Hope we have
So
answered your question.
So yeah, thanks Vikas for explanation. And I'm gonna coming to the lease doc part in later in the webinar. So I will explain more
Yeah.
about that. So guys, I want to show you in last 2 weeks time, in 15 days, we have finalized 11 commercial properties. These are recent transactions we have done. We are not talking about past 6 months or 1 year. So you can see out of the 11, we have bought 6 properties which are below 500,000 or close to 500,000, and all of these properties have net rental return above 7% with single tenant, multiple tenant, lease in place, strong lease, strong tenants. So all these myths which are in the market that you can't acquire a good commercial property with less budget is just a myth, because there are 11 properties. I can't show you all the 11. I will just show you 2 of them just for your understanding and to give you more idea about the properties that we have secured. Let me talk first about the property that we bought in Malvern East. Those who live in Victoria or knows about Victoria, they know Malvern East is a very high profile suburb. The median house price in Malvern East is above 2 million, median house price. So we bought this property for 540,000. The asking price was 580. We closed the deal at 540, and the net rent of this property is 40,000 plus GST plus outgoings. A brand new 3-year lease has been signed in June 2026. So lease is running till June 2029, and this restaurant is there from last 9 years. So it's a long-standing tenant. So I will show you some of the pics for your reference as well. It's on the main road with strong foot traffic, long-standing tenant, strong lease, strong rental return, where the median house price is more than 2 million. You can understand the area. And we bought this property for 540,000. Its rental return is above 7%. So this is the one of the property we secured for our client.
And
It's
this property, and Rakesh,
yes.
and Rakesh, this property qualifies for the 80% LVR, right?
Yes.
So like the buyers whosoever, like they have less than 200,000 of budget, like majority of the buyers, like we come across, they say we have a deposit of only 150 or 200,000. So if we can buy something. So this property qualifies for 80% LVR because of the postcode of the property.
And on top of that, because this property is built in around 2000, not very old. So the our client is getting around $10,000 annual depreciation for the first full financial year. So $10,000 is a big amount. It's indirect income. So there is a positive cash flow around 15,000. So out of 15,000, 10,000 will be offset. No tax needs to be paid on that 10,000. So this is one of the example. And the another example I want to show you, we have secured a property in regional Queensland. Again, it's a very strong example where we beat, there was 17 offers on this property. So if you see this property, this is multi-tenanted property. The land size is 857 square meter. The floor area is around 350 to 360. Just the replacement cost of this building is around 1 million. If you just need to replace this building, there's just 1 million cost to replace the building. There are two tenants. The total net rental return is 30,000 plus GST plus outgoings. So two tenants, one is a Aboriginal corporation. They have 4-year lease till 2029 plus 2 4-year options. And there is an ATM of the NAB Bank, which is paying 9,000 per annum. There is 2-year by 2-year lease, and it was a NAB building before. So the original tenant of this building was NAB. The NAB vacates the building, but it's now tenanted by Aboriginal Corporation, which is a government funded. And NAB still have the ATM there, and because of the big four, NAB has no plan to move the ATM because that's the only ATM in the town, the only ATM. So there is no plan to move this ATM out of the town. So it's an office of a
And
Aboriginal.
Rakesh, one more thing, like, yeah, Rakesh, one more thing. I guess it was a mortgagee sale, right? So if
Yeah.
any common investor, wants to buy this property, so sometimes the people get scared. It is a mortgagee sale. I don't know what does it mean? There is any risk? What? But for us, basically, it is an opportunity.
So that's part I was going to explain that because it's a receiver sale, it's not a normal vendor sale, receiver sale or mortgagee sale, same thing. So that's where they got 17 offer because the approximate market value of this property is 420. I talked to 3 to 4 different agents and did some the market appraisal of the property, and that's where they got 17 offer. We couldn't secure this property at 295. We secured at 315,000. Even at 315,000, there is a positive cash flow. Let me show you on my PPT how much positive cash flow still there.
15,500.
So there is a positive cash flow. I'm talking about this property. We secured it for 315,000. There is a positive cash flow of 15,500 with 2 tenants and both strong leases. And because it's a big building, the annual depreciation is also around $15,000 to $18,000, considering the size of the building. So these are 2 examples. I can talk about 1 hour on this example. It's never ending. So if you need more, if you want to talk about more specific about any of these we have bought in last 2 weeks, you can call me or Vikas and we can discuss further on these transactions. Now I'm going to talk about 4 more transactions which we are right now negotiating with the selling agent and we are buying for our client. So one of them is in regional Queensland, where the population is more than 25,000. The price we are looking is 260,000 will be the purchase price, and the net annual rent is 25,000 plus GST plus outgoings. So the rental return on that property is 9.62, and this property gonna give 13,000 positive cash flow at 70% LVR, considering the market interest rate of 6.77. So all these calculations are based on 70% LVR and the interest rate of 6.77. If you are buying under SMSF, there will be interest rate of around 7.7, 7.8. So the positive cash flow will be a bit less. So there is another property that we are negotiating. Hopefully, we will be able to buy in a couple of days or by next week. So it's in Melbourne Metro, less than what goes in outgoing. So Mohammed, I will answer your question in 2 minutes. So it's in Melbourne Metro, less than just 20 kilometers from Melbourne CBD. The population of that suburb is more than 20,000. The purchase price gonna be 440,000. The net rent will be 30,000 plus GST plus outgoings will be paid by tenant. So rental return is 6.82. You will say it's on a bit on the lower side, but because in a metro, just 20 kilometer, the property gonna be having much more potential for capital growth because of the metro, and still it will give you 10,000 positive cash flow, 3-year brand new lease till 2029, and there gonna be further options. Another property in regional New South Wales, purchase price 250,000. Population of the town is more than 17,000. The annual rent is 23,400 plus GST plus outgoings. There will be a positive cash flow of 12,000. The lease is till November 2028, and there are further options as well. The last one that I'm talking about, it's the showstopper, or we can say the main property that I think should be suitable for the SMSF buyer. It is a brand new building, just built in December 2022. Uh, Very high value depreciation. The population of that area is 35,000, and it's highly rapidly growing area. It's in Melbourne Metro. The purchase price will be close to 695. We are still negotiating. The asking price is 710, and we are negotiating, and we can close around 690, 695. So the net rent will be 41,500, although the rental return is 6%. But if you compare it with the depreciation you are getting, the indirect income you are getting, this rental return is very good considering the location, tenant, because there is a new tenant. They have spent more than 200,000 on fit off. So if you talk about this property, the tenant has spent more than 200,000 on fit outs of the property. If someone's spending 200,000, they have no plan to leave the property. So it's going to be a long standing, long term tenant. 9,000 positive cash flow on a purchase price of 695. Now, the question was there regarding outgoings. So, those who have never bought any commercial property or have not done much research, so outgoings means your council rates, water rates, and your building insurance, any strata repayment, any emergencies levy, or sometime every state have some sort of separate outgoings. So, outgoings include all the soft expenses that you have to pay to hold the property other than mortgage. So in residential property, if you have investment property, you are responsible to pay all the outgoings like council rate you are paying the water rate, you are paying the building insurance, you are paying any strata repayments, you are responsible for all the internal maintenance of the property. But if you are buying commercial, the internal maintenance and all the outgoings are the responsibility of the tenant, which gives you peace of mind because the outgoings sometimes increase by 10%, 20%, 25%, which impact your cash flow. But being paid by the tenant, you don't worry about the outgoing part. So now, talking about commercial financing, as Sandeep has asked the question of, yes, Mohammed, I will come to your depreciation once towards the end of this the webinar. I will answer your question. So people have a lot of concerns about the financing. People think it's very hard to get finance for commercial properties, or you can get only 50%, 60% maximum LVR, or even if you get the finance, the interest rates are very high. They are confusing the commercial finance with the business finance. These are two separate things. If you're buying a commercial property, it's a different type of finance. If you're buying a business, like you're buying a Subway, you want to run Subway business. You're buying a cheesecake shop. You are buying a cafe. That's you are lending the money for the business. So that's a different scenario where the interest rates are 8%, 8.5%, 9%. But when you're buying a commercial property or commercial asset, then the interest rates are very much similar to the residential, which is around 6.5, 6.6 in today's market. We are getting anywhere between 6.5 to 6.8 in today's market. For Resi, the interest rates are around 6.2, 6.3. Now, a lot of our investors have the problem that they can't borrow for residential because they have exhausted their serviceability. So in Resi, if you have exhausted your serviceability, there is no way you can get the lending from the big four. You can still go to the second tier, third tier lender, paper money. There are so many lenders which lend you money. Again, the same thing comes as Sandeep asked. They charge you the risk fee. They charge you higher interest rate because they are lending you money without you don't have enough serviceability. But with commercial property, even if you have zero serviceability, still we will help you get the lending from all the big four banks without any risk fee, without any higher interest rates. So up to 70% LVR just based on the lease income of the property, you can lend the money. If you're going with full doc, like you are able to give your salary income, your income proof, you can go up to 80%, just standard financing you going. If you're going with low doc, you still can get 80% LVR, low doc, as I mentioned, going to second and third tier lenders, but there will be a risk fee involved and there is a higher interest rate. So if you're going to SMSF, up to 80% lending is possible for commercial properties. As I told, Vikas told, for each small one property, we are buying for a client who is buying under SMSF, and we are getting 80% lending for that property. So you can go up to 80%. So now there is a question why people go with low doc properties when there is a lease doc option available. That's a very common question that I have to answer. So the reason is sometimes few investors have their bad credit history. They have done something in the past, either knowingly or unknowingly, which have spoiled their credit history. So the big four, the big lenders won't lend you if your credit history is spoiled or you have done something which they don't like. So then you have to go to the second or third tier lender, which gives you, which consider your file even if you have a bad credit history. So that's where people go to the low doc and they get up to 80% LVR with risk free and bit higher interest rate. Now I will take the question of Sami. Sami talking about depreciation. Am I right? Let me see.
Yeah.
Sami, you say, can you please explain how depreciation helps and how we can calculate this for different properties? So Sami, how depreciation helps? Let me come back to the previous slide and I can help you with I can explain you with the help of example. Let's talk about this property. I'm talking about Molvan East property, because that's the one we are buying currently. So this property we are buying for 540,000. Net rent is 40,000, and the positive cash flow on this property is 24,759, and it's a restaurant. Now, positive cash flow means it's your income. Any income you are getting, doesn't matter you're getting from your job or any business or any property, you are supposed to pay tax at the end of the year. When you file your tax return, you pay the income tax based on your income. So if suppose there is no depreciation, zero depreciation, this 24,000 is liable for tax. So you're gonna pay tax on this. If you're buying under your personal name, it will become your personal income. Depending on your income bracket, you pay either 37.5%, 25%, 48%. If you're buying under your company or trust, then company and trust interest rate is applicable, the tax rate is applicable. But for this property, there is an approximate depreciation of 15 to 18,000 for this property. So at the end, when your accountant gonna filing your tax, so from 25 4,000, let's assume the depreciation was 15,000. So 15,000 will be taken away. You will be paying tax only on 9,000. Out of 24,000, you saved tax on the 15,000 because of depreciation. So this will happen every year, but it's not same. The depreciation will not remain same every year. It will keep on decreasing because your asset is getting older and older. If it's 15,000 for the first year, next year it may be 14,500. I can't tell because I'm not an expert. So there is a depreciation schedule created by the licensed people. They are known as quantity surveyors. They create a depreciation schedule for next 40 years, so which gives value, and based on that value your accountant will depreciate your asset every year, and those are licensed people. The report given by them is a tool which will be used by all the accountants. No one can challenge that report. So it's not created by you or me, it's created by the licensed people based on the age of the property, fit outs in the property, all the other items in the property which are depreciable. Hi, Mohammed. I hope I have answered your question. Yes, Mohammed.
Yeah, that should be fine.
Okay. So depreciation is not direct income, but it will help you to offset your tax. So instead of paying tax on 24,000, you're not paying on 24,000, you're paying on 9,000 because 15,000 is your depreciation. Let's move forward. I talk about this. We talk about this. Now, these are some success stories. It's not around 500. It's just we bought some good properties in the past. So we bought a property, one in Morwell. We bought it for 2.35 million. The net positive cash flow of that property was 74,000, and it's a government tenant with till since 2017, and the annual depreciation of that property is 50 to 70,000 because tenant has spent 1.6 million in fit outs. So in 2017 they spent 1.6 million in fit outs. There is a lease till 2029 plus 3 further option of 5 years each. So the lease is till 2044. The land size is 2,150 square meter freehold land. Another property we purchased in Innisfail for one of our client for 750,000, and the positive cash flow of that property is 52,000 per annum on a 750,000. There is a bit of story behind this. When we bought this property, when we signed the contract, out of the three, there are three different commercial spaces. Two of them were tenanted and one was vacant. And we were expecting that space to be tenanted between 3 to 6 months' time. But after signing the contract, within 2 weeks of time, we find the tenant, and the tenant was in there before the settlement. And that tenant was paying 30,000, which adds up the total income, and the positive cash flow became 52,000. And net rental return become 11.13%, and there is approximate 15,000 depreciation per annum on that property. So you can assume you added an income of almost one person by buying a property of 750,000, even in today's high interest rate. So when the interest rate gonna go down in the coming months or coming years, and your income gonna increase because of 3%, 4% increase as part of the lease, your positive cash flow will keep on increasing. Another property we bought in Glen Eames for 560,000. It's a very good town. It's an industrial property. People love industrial assets. And it's a newly built. It's built in 2019 only, not very old, still under warranty, new property. And it's giving the cash flow of 15,500. Although the rental yield is 6.9%, but considering the age of the property and the size of the land and the covered area, this property is a good asset for long term. Last one I want to talk about, we bought in Springshore, Queensland, which is occupied by a national tenant. It's not one of the major tenant, it is the major agriculture supplier of Australia. So they have more than 500 branches. So purchase price is 990,000. It's having office space, a warehouse, and a four-bedroom unit attached to it. So the whole space is tenanted by the same company. The four-bedroom unit is occupied by their manager who is running that site. And there is a positive cash flow of 46,000 per annum. And we bought this property under SMSF for one of our Victoria client. So you can see now, these are the real examples. If you want to know more about this, all these success stories are available on our website with more details, photos of the properties, talking about more about that lease terms and everything. You can check our website and get more information. Or if you still have any specific question, you can call as me or Vikas anytime, and we are happy to help with any of your questions.
Rakesh, there is a question from Washington.
Yes.
How did you come up with the rental yield of 11%? Purchase price 750,000, rent
Let-
52,000.
750,000 net. Let me show you with the help of a calculator. I think that will be the best way.
You can open our financial summary sheet otherwise.
So I can go with financial summary sheet. So that will give you even in them more. I can explain even bit more things with that. That's easy. So what is the purchase price? Because let me bring it.
Purchase price was 750,000.
750,000.
Please zoom in first.
It's not visible. Is it better now?
Yeah.
Okay. So let's go with 750,000. 750,000 is the purchase price. And do you want me to put these other values genuinely as well? We'll go with everything genuine, so that like genuine means
Yeah.
actual value. That's the deposit. The stamp duty will be around 35,000 on this. It's in Queensland. 35,000. Conveyancer fees, there is no conveyancer, it will be around 3,000 because it's only solicitors are there in Queensland. Bank valuation fee depends. If you're going with non-CB, it will be some value. We'll put it 3,000 because of a big property. And then building and pest inspection, we put $1,000 again. And that's the buyer agent fees and some buffer. So for this property of 750,000, we normally go with 30%. At 30%, you need cash of 285,000 to buy a property of 750 with 30% deposit and 70% LVR, and all the expenses, soft expenses are included with some buffer as well. Now let's move. What is the net rent of this, Vikas?
It was $83,500.
83,500 was the net rent of this property.
Correct.
So what is the interest rate we got for this client?
Interest rate I have calculated at 6.55%.
6 point. We got 6.55 for this client. Okay. Let's put 6.55. 6.55 and 6.55. 6.55. So we calculate based on three different 20% LVR, 30% LVR, 35%. So if we go with 20% LVR for this property, if you're buying at 20%, you're paying annual interest of 39,300 at 6.55% interest rate, and your positive cash flow will be $44,200 because the net rent is 83,500. The mortgage repayments are 39,300. So net positive cash flow is 44. At 30%, it's 49,000. At 35%, it's 52,000 approximate. So, and
So
the net rent.
basically, Washington, yeah. So for this property, we have calculated the numbers considering 65% LVR because this we purchased at 65% and 35% was the deposit. And now you are saying how the rental yield of 11% on this. So 52,000, it is not the rental income, right? Rental income is the 83,500. And the formula for calculating the rental yield is rental income per annum from the property divided by purchase price of the property. So if you see here, rental yield, it is 11.13%. So 83,500 divided by 750, which will be the rental yield of the property. But
Okay,
52,000 is the positive cash flow.
So how we calculate rental yield in the future as well, maybe it will help you. So then we put the net rent, which is 83,500 divided by the purchase price, which is 750. So then
7
into,
millions. Yeah, it was okay. So it's like 11.13%.
so the net rental return is 11.13%. So that's the net rent.
So this
For
is
any
the rental
property,
yield.
what you can do, you can put the net rent divided by the purchase price, multiply by 100, it will give you the net rental return of that property.
So if you want to calculate the ROI, like the 52,000 figure will can help you to calculate the return on your investment, right? For example, if you are generating 52,000, right? So 52,000 divided by, so how much deposit she has, like the client has put at 65%, Rakesh, on this 322.
Deposit
So
is
divide
but
deposit is
260.
this 322 500. Divide this 322
Yeah, total
500.
including soft expenses, everything.
Yeah, exactly. Because I have taken all the expenses.
In
So
200.
16% is your yearly return on investment on this property.
So 16%, which if you keep in your savings, you get 3%, 3.5%. Even in SMSF, you are getting maximum 10 to 12%. 16% is year-on-year return on investment money you spend, plus the capital growth that you are getting. That's there, which you won't get if you put your money in SMSF. You're just getting from your the super industry funds. They are giving you 10%, 12%, 14%, whatsoever annual return, but there is no capital growth on these type of assets. You are getting good return on investment. At the same time, it gives you capital growth, plus your income is increasing every year with the rental increases and all those things. I hope we have
And going
answered your
forward, as
question.
Rakesh mentioned, like if there is a 3% rent increase, so every year this 52,000 you are getting today, right? But going forward, this cash flow is going to increase on year basis, right? And if the interest rate comes down, for example, we all know today we are sitting at a highest interest rates, and if the interest rate goes down, so then this cash flow again will become high.
So see,
Rakesh, no
they
need to
are.
explain this. It will be a little bit
It
too
will be
tricky.
a little bit too high. So if anyone if interested in more calculations, more numbers with us, we can arrange a special session separately. We can talk to that person because otherwise too many numbers, sometimes people get confused. So we don't want to go into too much numbers now. So moving forward now, let me come back to our. Hmm. So I was talking about these four examples which we have already discussed. Now, some of the news in the media, what experts are saying, all these are latest one after these new announcements from the budget, from SMSF announcement, the changes in the SMSF investments. So you can see all these are, we're going to share this PPT with all of you. You can check these news. There are links for all of these news. They all are talking about that the commercial market is the next boom. So those who will invest early, they will be the major beneficiary of this. Like I normally give example, people are still investing in Perth, people are still investing in Brisbane or in Queensland. But those who have invested in 2020, 2021, they took the real benefit. They got the maximum capital growth on their properties. Same thing gonna happen with this commercial market. Those who will start early, they gonna get the maximum benefit in the future. So Prabhat is saying something. Let me see what he's
Before
saying.
Prabhat, there is a question from Washington again. Generally, how are commercial properties valued?
So generally, how commercial properties are valued. So there is no one criteria. Like in residential, the criteria is land size plus the dwelling size. So if you're seeing four properties in same area, one is the land 400 square meter, another is 480, then another one is 540. So as per the land, the 540 land has a higher value. Then you see the build size. It's a 3 bedroom house. It's a 4 bedroom. The third parameter is how old is the house. So based on that, you can easily find what should be the value of the house by comparing other sold properties in the market. But the commercial properties valuation is working in a different way. These commercial properties are valued based on the location of the property. If there are two properties in the same suburb, one property is in the high growth, high traffic location where there is a high foot traffic. It's a big shopping complex where there are other big shops are there. Different type of the purchasers are coming to buy their stuff in that market. And one property which is in a small area, just two or three shops are there. That's the one factor. Then who is the tenant? What sort of tenant is there in the property? So that also matters in terms of the valuation of the property. How old is the property? So commercial properties are not valued based on just on the size of the property, that if there are two properties side by side, both of them are 100 square meter each, and then their value will be same. No, their value varies with the amount of lease pending, with the tenant in place, and how well that property is maintained, which is different in residential. So the good part about commercial property is when you buy property, there is a complete, like a full valuation done by the bank. Either it's done by with your money or bank is paying themselves, like CBA is not doing their own valuation. So in that valuation, it's a complete report of more than 100 pages where they compare from each and every angle, per square meter rental amount, per square meter land size, per square meter building size. And if there is an inflated value, like the property is rented at 100,000 and the purchase price is 800K, the average rent in that area for 800K property should be around 80,000. So it means the rent is inflated. So it doesn't mean that you will get the complete valuation. So valuation comes shorter than the purchase price if the rent is inflated. So all these things are done by third party valuers. They charge money, as Sandeep was saying, $2,000, $3,000, $4,000 depending upon the property location, property size, and they give you full report with all the comparables. So how that's the way the commercial properties are valued.
And moreover, Rakesh, like if you can present the practical example, like you remember, you are working on two properties in Emerald area, right?
Yeah.
Those two properties was just next to each other, but because of the strength of tenancy in one property, because of the business of the tenant in one property, the valuation was higher.
Yes, that's 100%.
Yeah.
So we were looking at two properties and they were next to each other. It's not like in a different street or in a different suburb or a different part of the suburb. Two properties, similar time built, similar type of structure. One property got the higher value because there was a national tenant in place, and it was a tenant with the like presence across Australia and strong fundamentals. So bank consider it as high less risk, because when your property is vacant, there is a lot of risk. Even insurer won't insure your property. I have one property. One of my property got vacated last month. It's in Moi, Victoria, and my insurance needs to be renewed. Um, I got a call from my insurance that we are only insuring your property for next 6 months, and if your property is not tenanted within next 6 months, maybe we will not continue your insurance. So you can see, if there is a national tenant, if there is a strong tenant in place, the bank consider the all the different third party agencies consider it as a strong asset. Now, Prabhat is asking, what is the process of engaging your team and start looking into? So, Prabhat, I think I already have a chat with you. We had a good chat about engaging process, I think couple of weeks back. But you can call me anytime because the engagement process and the fee structure depends on different type of purchase or your budget and so many other factors. So I don't think so. This platform is right to talk about our engagement process. But yes, you can call us anytime later, and either me or Vikas can explain you the engagement process, fee structure, what are the different formalities involved in engagement.
There is a question from Matt. Rakesh.
Matt saying, given the trust tax staging announced in the budget, what is the structure people will be using going forward? Known as MSF, own name, company or trust. See, again, Matt, this question will be best answered by your financial planner or accountant because I don't know about your current situation. Even if I know, I don't know how tax works, what are the different ways your tax can be saved, how tax can be restructured, if you should buy in your personal name or you should buy in SMSF, sorry, in your trust or in a company. But I can talk about my personal situation. I have bought two commercial properties, one this year and one last year, and I bought both the properties in my family trust. Because family trust, I get the maximum uh, value because I can uh, transfer, I can give the income to my family members if they are not working, if they have less income, and there is a like the tax is fixed on the company or SMSF, sorry, in family trust. So I'm buying under family trust, but for your situation, I think you should talk to accountant. So Sandeep is saying your thoughts on demand shrinking, businesses leaving Australia. Last visit, business left and 48K businesses went bankrupt due to high cost of operation. 100% Sandeep, your question is very much valid that the businesses are shrinking, businesses are getting defaulted. It's happening around Australia. But you're not saying that new businesses are also starting. These are the numbers you are talking about. Those are leaving the premises or closing their business. But at the same time, there are people who are starting new businesses. There is a lot of migration happening, a lot of new investors jumping into the market, and they are starting with the new ideas and new businesses. But yes, this risk is always there. And then how we mitigate that risk, as I mentioned before as well, that's the due diligence done by Make My Property team. So if you're buying a property having a just retail in that space, just they haven't spent money on fit outs, their investment on the property is minimal, then the chances of that tenant leaving the property is very high. But if you're buying a property, like I gave you an example, we bought a property in Springshore. The tenant was Nutrien AG, Nutrien Agriculture Solutions. So they are the biggest agriculture supplier of Australia, having more than 500 branches across Australia. You can research on that, Nutrien AG. So if that type of tenant is occupying your premises and the tenant having that property is in agriculture dominated town, so the risk is very much covered. So it's all about what sort of asset you're buying, what sort of tenant. If you're buying randomly with any tenant, yes, risk is there. But if you're buying, like I mentioned you, we bought a property where like in wallet property we haven't bought, but we are negotiating. The tenant has spent 200,000 on the fit off. It's a new brand new cafe. So they did amazing fit off. So I don't think so they're gonna run away. They will sell that cafe in the future if required. They may get retired. They may sell the cafe. Tenant will be changed, but for the landlord, it will still be tenanted. So Sandeep, Sandeep, have I answered your question? Good.
Yes, Amazon.
So Mohsin was asking, promising now. That's good. Mohsin, if you have any question, please free to ask anytime. Let's move forward. Again, I will say, just adding to Sandeep's question. So if your due diligence is not good enough, people losing money on any type of investment. I have seen people losing money on residential. I have seen people losing money in the share market. I have seen people losing money in the crypto market. At the same time, I have seen people becoming millionaire in the share market, becoming millionaire in the crypto market, getting a good capital growth in the resi market. So it's the same market for everyone. It's not two different markets where people losing and making money. Same market, but it depends on your entry and exit strategy. It depends on your due diligence. It depends on your emotions attached with that asset. If you're buying practically with the numbers, not with the emotions, and with some professional guidance and some data backed approach, the chances of going wrong will be less. But I can't say there is always a perfect situation, but the chances of losing money will be much lesser if we are doing with proper due diligence. That's what I want to add here. Time for question answers. Anyone having any questions they want to ask? Uh, Guys, time for your questions now.
Like though we are already having the questions during the session, but if you have anything specific or you want to ask, so you can ask here. Otherwise,
So it's saying with 30% tax on trust, beneficiaries sharing leading to double taxation. Is it still a viable structure to buy commercial in trust? So, Sandeep, again, these rules are changed just now, and I'm not quite sure like what should be the right way for you guys. How I take it, because I have few residential properties in my trust and few commercial. I have three different trusts right now. So with a mixture of residential and commercial, because residential properties are more negatively geared and my commercial properties are positively geared, though they are offsetting each other. So I'm not worrying much about the tax at this moment. But again, um, my situation is a bit different from all of you. So you can talk to the financial consultant and they can give you proper guidance that what should be your buying structure. But I will always say people always worry about the tax, that if I buy this much will be my capital gain tax. If I do this will be my tax. They don't consider what you are getting out of that. If you're keeping your money with you, you are not getting anything. If you are buying something, if you are paying even 30% to the government or 40% to the government, still 60% will be coming to you. You should worry about the money you are getting. Why you are worrying too much about the money you are paying to the government? So that's what my thinking is. I pray to God every day that my tax should increase by 10 times every year. Last year I paid around 500,000 in my tax altogether. I want it to be around 5 million next year and then 50 million next year. If I'm paying 5 million in tax, it means I'm making 20 million. So that's my approach. I want to pay more and more tax every year. Paying tax is something you are doing something good. That's what I think.
people are asking about the engagement model and regarding the fees. Actually, basically we run this webinar to provide the knowledge, to share the knowledge, to have the questions and to answer that. We do not focus on the engagement or focus on our fee part. So if you guys have any specific questions to on that, so feel free to call me or Rakesh or any other team member. So happy to provide the answers on that.
Okay, Mohammed saying regional versus metro, and what's the minimum deposit you think I should have to get started? Then what is the growth plan? Means how can we buy more properties in future? Do I have to create deposit from my personal income? Okay, so Mohammed, if you have a really good budget going above 1 million, 1.5 million, 2 million, something like that, considering metro will be a good option for you because you can secure a good freehold asset with that budget. But with a less budget, we prefer to go to regional where we can get a freehold good size property for our client and a strong tenant. So that will give you much more capital growth as compared to metro with the less money. Regarding buying more properties in the future, it seems works like residential. You buy a property for 400,000 today. After 3 years, the property's value is 600,000. You refinance the property, take the equity out, and use that equity to buy your next property. So same like residential, you can get the equity out anytime. You can refinance that property and you can buy the next property. Even refinancing is much easier in commercial because there is a lease doc product which always allows you to refinance even you don't have serviceability. I have seen a lot of investors coming to us. They have a lot of equity sitting in their residential properties, either they are owner occupied properties or their investment properties, but they can't take that equity out because they don't have the serviceability and their equity is stuck and they can't buy anything. But with commercial property, if you have equity, you don't have to worry about serviceability. With the lease doc, bank will lend you money, will take your money out, whatsoever extra money, and you can use that money to buy your next asset and then keep buying assets as you keep on accumulating more and more equity plus your own deposit. I think I have answered your question, Mohammed. That's right.
Prabhat, yeah.
100% Prabhat. In SMSF, there is no way to take your equity out. You can only sell the property and take the equity out. You can refinance your mortgage and get a better interest rate, get offset account or other things which are associated with the mortgage. But there is no way you can take the equity out in SMSF. Doesn't matter it's a residential property or commercial. It's not only for resi or commercial. Any type of asset you buy in SMSF, you can't take the equity. If you think you have bought it for 500,000, the current value is 1 million. I will say if your loan pending is 300,000, sell that property, take 700K out and buy 2 or 3 assets with that 700K cash you got after selling the property. That's what you can do in SMSF, but you can't take the equity out.
And moreover, like I want to add, like one of our investors, he mentioned when he was buying a property, it was a resi property. So he deposited maybe more than 50%. So he was not knowing like the later he will not able to withdraw that. So then he was regretting, basically I could buy that property with 20% deposit, but I put 50% deposit. So he was not able to take that out. So whenever you are buying any property under SMSF, talk to the professionals, have proper guidance, and only then invest. Because in SMSF, it is a one-way traffic. You can put the money in, but you cannot take the money out, right? So, yeah.
So Mohammed saying just a few words on servicing. So Mohammed, as I mentioned multiple times, Vikas and me, in commercial property, there are different ways to get the mortgages. Full doc, similar to your residential properties, where you give all the documents. All the documents means all your income documents. It can be your personal income, it can be your business income, it can be from your, if you are working as on your ABN. So any type of income, if bank sees all your liabilities, any mortgage, any car loan, personal loan you have, and comparing with your income, and if you have serviceability, you can buy the commercial asset with 80% LVR. That's a full doc, like buying your residential property. But if that, like a lot of commercial properties in the market in the past are bought mainly by the businessmen because they understand commercial properties, they know how it works. And for businessmen, sometimes they are not comfortable giving their ATO portals because they haven't yet lost their tax returns for the last year. They still have to lose their GST for the last 3 months or 6 months, and bank won't proceed until or unless they don't have updated documents. So for those people, then they goes to lease doc, because in lease doc, bank won't ask any single income document. They don't take care. Even if you are not working, you have zero income at all, you and your partner are totally sitting idle. But if you have a cash to buy the property, if your cash is in your account and there is a lease income coming, good lease income coming from the property, bank will lend you money based on the lease income of the property. And that's where a lot of people feel much more comfortable going with that leased doc product.
There is a question from Prabhat. I have 2 resi properties in SMSF and approx 160K cash. Do you reckon I will be able to buy commercial property under SMSF in this situation?
Yes, Prabhat, 100%. For your situation, similar to your situation, we have few clients, we have bought commercial properties with 100K cash, as Vikas mentioned. If we go with 40%, like 30% your deposit, 5% stamp duty, and 5% other soft expenses, plus some buffer you need to leave in SMSF, you can easily buy a property of 400K in your commercial. And I think I have gave you the number of mortgage broker as well in the past. If not, I can give you, he can check your serviceability, he can get you some real numbers from the bank that how much they can lend and what will be your interest rate, and you can then move forward with your purchase.
But I guess they will also check their servicing as well, because on the 2 residential properties, he must have some sort of loan and he must be paying the mortgage on that. So for getting the third, it will be a full doc under SMSF, right? So the broker will check your numbers, he will run the servicing test, and then he will advise you how much borrowing you can get. And on the basis of that, you can proceed.
Yes, please. Yeah, that's what I'm saying. Yeah, we'll check it with the mortgage broker. But yes, we have done we have bought properties with the people having 2 or 3 residential properties in their SMSF. But again, their situation or your situation may be different. They may be earning a lot of money and their employer contribution is much higher. Or see, everyone's situation is different.
Correct.
Sandeep saying with 80K in Supervat max purchase price, we can buy 180 to cover deposit and all buying expenses and small buffer. So, Sandeep, if I go with 40% rule again, anywhere between 450 to 500K property you can buy easily in 180K. Again, as I mentioned, the property we are buying in Malvan East with 20% deposit. If the property qualifies for 20% deposit, then you can easily go up to 600K property with some buffer and all the soft expenses. So you can say, if I say from 450 is the minimum that you can 100% go, and 600 is the maximum. For from 450K to 600K will be your range with 180K in super. Sure, Sandeep. Thanks for your kind words.
Yeah. Thanks, guys. Anyone has any further questions? Otherwise, it is already 90 minutes approx. So
I think it was a good engaging session. Lot of questions from investors, and hopefully we have answered your queries. And if you got more queries, because once you get answers, you get more questions from the answers, please book a session with us by visiting our website, or you can call me and Vikas. We are happy to answer any of your questions, because we want you to buy or go into any investment with full confidence, not just because others are doing, that's why you want to do. No, check your, do your due diligence, get your answers, and make sure you are confident. Then only you are buying. You're not buying because your cousin has bought, because your brother has bought, because your friend has bought, and it is lucrative to you. Get your answers and then move forward.
thank you, guys.
Thanks a lot, everyone, for coming. Talk to you soon. Have fun.